how does wages impact inflation? If wages goes up or wages goes down massively, how does that feed into inflation, and why does the market care so much about wages? Obviously, wages was one of the big reasons why we had the markets reacting the way it did on Friday, with that big downside in year-over-year average hourly earnings from the US. It wasn't the only reason, of course. The other reason was the fact that the markets were just pre-positioned for a very strong jobs number, which of course we didn't get. So there was a little bit of a sell effect by the rumor reaction coming out of that as well. But to Abu's point here, or to his question, why exactly does the market care so much about this? The reason why wages are important for inflation, Abu, is because the two basically they feed off of each other, and in some pretty nasty cases can lead to what is known as a wage price spiral. Now, the markets have been very cognizant of the risks of a wage price spiral in the current inflation environment, and I'm going to explain why those risks have been increasing. But in the current environment, I don't think we are close to a wage price spiral. I think if inflation is coming down, that I think wages should be coming down alongside it, and I'll share a chart with you in this video that explains that in a bit more detail. So let's start at the beginning. Let's start with inflation. Inflation is usually a constant thing. Let me show you what I mean by that. Let's quickly just open up this. This one will work. Okay, so here we have inflation year over year. And what I mean with inflation is usually a constant thing. What I mean by that is that it's very rare for inflation to go into negative territory. We very rarely get negative inflation year over year prints. We've had it 4 times in the US going back to the 1950s, twice in the 50s, once in 2009, or 3 prints, but in 2009, and then briefly, very briefly in 2015. Now, the reason why that's important is because as inflation is always a constant thing in our lives, most employers and employees will usually look to something like CPI as a yardstick for discussing things like wage increases. So, for example, if inflation is 2%, then workers will be hoping for at least a 2% annual wage increase to cover the increased cost of living. Now, obviously, some employers might offer less, some might offer more, but the point is that the level of inflation is important for its part in wage negotiations. Now, the thing about wage prices going up also means that regular prices normally goes up alongside it. Well, at least usually they do. So, for example, let's say a company gets away with a 3% average wage increase across its entire labor force. That 3% increase in costs needs to come from somewhere. Now, if the company is in a really tough economic environment, that cost could sometimes be absorbed by the company because they don't want to necessarily raise the prices of their products or their services. They don't want to price themselves out of the market. They might rather choose to have those wage increases eat into their margins. However, in times when the company and the economy can handle higher prices, or in an environment where all other costs are increasing massively, such as what we've had obviously over the last 18 months, where material costs are going up and energy costs went up and transport costs went up. If all your suppliers, for example, are raising prices, you can't really just absorb those additional increases in wages. You need to raise the price of your products and services or whatever you are selling to basically make up for that increased cost. But that increase in end user prices feeds back into inflation. Now, this is more manageable when inflation is running at 2%, between 2 and 4%, or very close to the central bank's target. But when it's running at 8% or 8.5%, like it did a couple of months ago, that's a whole different ball game. So, for example, with inflation at 8%, your suppliers are going to be raising their prices as well, because everybody's prices went up. If your supplier is raising prices, they are raising prices because their suppliers have been raising prices. And that is because their employees wants to beat inflation. So when the buck stops at your company and you have prices going up on average, let's just say 12% from a supplier perspective, and now your employees demand an 8% increase to combat that inflation, it means that you have to put up prices of your product and your services, and you have to put them up with really punchy amounts. And then once again, that feeds into higher inflation. right? So when you have high inflation to start with, that high inflation has a very good chance of feeding into higher wages. And as wages starts to increase, that increases the odds that companies needs to once again put up their prices of their products and services, which once again feeds into inflation. So when you have that further increase in inflation, if it stays high, so let's just say you go from 8% this year to, let's say, 4%, we average 4% in 2024, then next year or this year's wage negotiations will require further rate hikes or wage hikes rather, and that will further push up prices of products and services. So high inflation, because it means that your buying power of your workers goes down, higher inflation usually requires higher wages. Now, something to explain that fairly quickly is just looking at this very, very handy chart from Fathom Consulting, where they basically have year over year CPI on your bottom axis and you have wages on your left axis. So what you can clearly see is that when you run inflation in that sweet spot, let's just say between 1 and 4% inflation here at the bottom, when you run inflation in that area, you are normally looking at a wage increase between 2 and 4%, or for wages to increase between 2 and 4%. But once you move into that upper bracket, like we've been at over the past couple of months, you can see that that requires normally higher wages to go up. And you can see that, that very interesting scatter plot showing you that relationship between wages and inflation. As inflation goes up, you would expect wages to do the same, but then as wages increase, you once again expect that to feed into inflation. Now, do keep in mind that inflation doesn't always feed into wages, though. You could have high inflation that doesn't translate into higher wages, because let's say the economy is going into a rapid slowdown, very much like we have right now, and you have people being laid off of work. I mean, how many companies have we heard who said that they are either freezing hiring or potentially laying off massive amounts of workers? When that happens, you don't really have people asking for a raise to match inflation if all around them, their colleagues are being laid off. So depending on the state of the economy, high inflation doesn't always translate into higher wages. You could have high inflation that doesn't move into wages, again, depending on where the economy is. And depending on the scale of the wage increases, it might not be enough to always feed into inflation either, because again, companies might decide to not hike prices by that much and rather just take the hit on their margins and make sure that they stay competitive in their arena. So there's a ton of caveats to keep in mind between wages and inflation. But I think that should give you a very broad sense of why it's important and why markets pay such close attention to drastic changes, either up or down in wage prices.